6 months ago, I was really concerned that it would be highly restrictive on our ability to get things done and our management team's desire to move things through. But ultimately, necessity tends to drive transactions, and it's amazing what people can do when there's a desire within those organizations.
Welcome viewers to this panel discussion providing some insight on how specialist mine finance providers gain an edge through their due diligence processes. This forms part of our suite of video sessions for the one-to-one mining investment EMEA online event for autumn 2020. I'm pleased to be joined by a panel of investment professionals with a breadth of experience across the natural resources sector. Introducing the participants, it's my pleasure to welcome Shaun, who's the CEO of Triple Flag, Philip Clegg, Portfolio Manager at Orion Resource Partners, David Halkyard, Head of Credit Strategy at Resource Capital Funds, and Will Coetzer, who's Partner at Stratum International, will be anchoring this discussion. So with that, Will, I'll hand over to you to take us through today's panel. Thanks.
All right, thanks a lot, Adam, and welcome everybody. Yes, I've been reflecting a lot around the global state of play and sort of asking questions on finding value. I mean, you've got the US elections playing itself out, you've got COVID, you've got all these macroeconomic issues, you have the EV revolution coming up, you have potential dollar devaluation, you've got supply shortages coming, you've got gold's role in all of this. So there's so many things to consider in this market. So I'm glad I'm not you in terms of trying to find value, but we are very curious. How are you continuing to find value, good quality projects, good quality companies in this current once in a 100-year environment?
Well, happy to kick off. I've always had the fundamental view that uncertainty is an environment that creates opportunity, and I do think private equity groups are very well positioned to be able to think through risk and think through scenarios and commercial protections very often perhaps better than you see with sort of corporate competitors. And it's not clear to me that a lot of corporates actually have a license to go out and do significant M&A, and I don't think they have had for some time. We've seen consolidation, but a lot of those have been without premiums, and guys seem focused more on discipline, demonstrating discipline at this time of the cycle. So for us personally, even with the restrictions of COVID, this has been our most significant year of deployment. I think that volatility early on, we saw some opportunities around groups needing liquidity and increasingly just value arbitrage opportunities. I think this year alone, and the year's not over, we've already deployed over 725 million. And it's, there's as much deal flow, if not more, in front of us than I think we've seen in our existence.
I would concur with that sentiment to a large degree. I think that one of the things I always say, Will, is that the wonderful thing about mining, there are some wonderful things, is that it's not just one commodity. There are loads of commodities to select, and some of them are at the high point in the cycle, and some of them are at the low point in the cycle. Everybody thinks about gold in that regard right now. Are we going to be running around doing every single gold financing deal that we can possibly do right now? Maybe, maybe not. I think we're pretty bullish on gold just as a general point. But really, now is probably more a time to start thinking about how one can start to think about liquidity events and monetizing some of the investments that we made when gold was 1,200. So that's perhaps how one might think about gold. But there are other commodities out there that are in the down cycle, and there's some way to go. You mentioned the electric vehicles. There are commodities associated with that look pretty cheap at the moment in the context of what we see from a demand perspective. The drivers behind electric vehicles and clean energy look pretty interesting to us at the moment. The other thing I'd say on this topic actually is that I think that PE firms, just as a general point, are quite good at thinking outside the box. Sometimes there are complex situations that need complex solutions, and one can unlock value from those if one is willing to sort of be an instigator, shall we say, in that sort of situation. So thinking about sort of relatively unknown private companies, steering away from competitive processes are ways in which one can find value. But as I said, there are situations right now which are a little bit messy, and with some capital and some, innovation, shall we say, you can find value.
Yeah, I think we'd agree with both Shaun and Philip in terms of what we see in the market, lots of opportunity, and I think gold always does tend to attract the headlines, but as Philip said, there's a lot of other commodities out there and some good opportunities in those. And I think there's still even in precious metals, there's still companies that are kind of below the radar because maybe they're domiciled in management's not in the obvious location for those the assets, and they're not getting the same love as others. So I think there's still a lot of opportunity out there and good opportunities to deploy capital and realize value.
Hey, Will, I think you're on mute.
Sorry. So let's talk about the next step post finding value. Let's call it de-risking. I mean, what are some of the essential disciplines that guide your investment decisions, considering all these commodities and options?
Yeah, I think, from our view, I think you have to try and take away from what's happening in the market today and think about your kind of medium and long term and where you want to be when you want to exit the group, and start evaluating the opportunities you see today in that light. I think if you put everything through on today's, for instance, some precious metals again on today's price deck, everything looks pretty good, but you won't necessarily see the opportunity. And say, things like lithium and so on, you might prices today are not so exciting, but the long term is there. So I think that's part of how you need to look at things. We're obviously very focused always on the quality of the asset, and the people that are there, and where we can bring value to a company that we're investing in, as well. So through helping execution, helping bring in the right people, as well as bringing in finance.
Yeah, so I think that from an Orion perspective, all the things that you mentioned there, David, that are completely applicable to ourselves, as one might expect. I would mention a couple other things as well, which I think are increasingly important to us all, I'm sure. But the big thing right now is ESG. It's just, it's everywhere right now, in terms of the investment community, not just in private equity, but others as well. It's just an area that you cannot get wrong. It's unacceptable to investors like ourselves, and it's unacceptable to the LPs that invest in our companies. So, is the framework right? Are the policies right? Is the culture right? Are they thinking about this correctly? You'd be surprised. There are companies out there in our space that are just not getting it right, and therefore they're just not going to attract investment from the blue chips. So that is the absolute key thing at the moment. It's top of the list, something that we've been taking really, really seriously at Orion. I think that to the point that David made on thinking about where one might be in the medium and long term is just crucial for us as private equity firms. And obviously we look at what we expect our return profile to be, on standard valuation metrics like IRR and MOIC and that kind of thing. But one thing that's really important to, I think, certainly to us, is the concept of optionality. So what I mean by that is, are there 2, 3, 4 ways to unlock value? What strategies can one employ to unlock value? Where can we take this company? What are our options? And so we really try and think carefully about, those multiple ways to make money.
Yeah, and look, I'd strongly echo what Philip has said. There's not a group out there, whether you're a private equity group or a strategic who's looking to invest in a mining business, that isn't going to do technical diligence at some adequate level. It never ceases to amaze me, though, how analysts, and I think corporates at times, or investors at times, view that in a very two-dimensional way. Our very first deal was a great example where we were competing with the largest in the sector, and with the way we constructed our teams and the first principles approach that we've particularly early on, when you're trying to demonstrate credibility with your financial backers, we were able to unlock things technically that others had substantially overlooked. And you only truly understand with some hindsight whether or not your interpretation was right. We always look at how competitive situations have evolved versus our interpretation, and of course our own. and understand if there are any areas in not just the technical diligence, but how we've interpreted that. It's seldom you encounter a situation where there isn't some optimism, at times extreme optimism, baked into the executability of these situations. And for us, we're maybe a little distinct in that our time horizons are actually very long. We may be in a situation for very, very many decades. And so I think, going to Philip's point, understanding that optionality becomes quite crucial to being able to understand that broader value proposition. I think the challenge we've got, perhaps unlike Orion RCF, is in assessing the ESG components, assessing management teams. We spend a lot of time as a gating item to understand, in the first place, the practices, because clearly, if they're problematic, we're just not going to go there. I think our challenge is, we are not taking controlling stakes in operating companies. So if we don't like management, very often it's quite possible in years to come, we might like management now, but in years to come, the next generation may be inadequate. So trying to understand what those risks look like, the sort of protections we can have, how we can structure those, becomes really important for us, because it's amazing how you can be held hostage to ineffective boards or ineffective management teams, whereas some of the guys on this team can take some very direct action to do something about that. For us, it's less of a an ability that we have with our model. So I think ESG is a gating item. Beyond that, understanding how we can positively influence it. And technical diligence isn't as two-dimensional. There's a lot of work that I think can differentiate how people view that and the quality of work that you do.
Thanks for that, gents. So let's focus on two key elements. Let's focus on the people element and also the ESG element, because these are clear major drivers, apart from the technical DD, of course. I mean, we all know a good leadership team can make a marginal asset profitable. We all know that a bad leadership team can destroy a great asset. So talking about people specifically that you invest in, I mean, some of them you would know, some of them you would have never met. I mean, let's talk about assessing and de-risking that for the firm and for your investors and for your backers. And also, once you have made an investment, what are your implementation strategies when reviewing these people and continuing to work with these leadership teams to generate the value that you sought when you made the investment?
So thank you. Well, maybe I can take that one first. I think that, so people is incredibly important, from our perspective, and that applies to the board, to the management team, to the workforce, and how that's arranged. Very, very important for us to understand that. It's advisory committees and the governance structures that are in place that actually pull that all together. That we do a lot of that work in-house, but we also use firms such as yourselves to assist us in really understanding, firstly, from a structural perspective, whether or not there are any gaps in the organization. But secondly, making sure that the guys that we're partnering up with are suitable, that have good reputations and are capable of doing the job, which is, to fulfill the unlocking of value and the strategy that underpins that. So in diligence, we look at all aspects of the group of people that we intend to provide capital to. So can the strategy be delivered? Can you believe that they could build this asset? Do we think that they would be able to sell the asset or merge it with another company? Is the culture fit for purpose? Do you have shared values with the organization? Are the ethics right? Can we work with these people? And so we do all that, and I'm sure the other guys are exactly the same. One point I would make in this particular area that actually was in the last couple of deals that our investment committee have approved, this applied, and that's the concept of a follow-on deal. So we might do, say, like an introductory transaction, say a relatively small one, say, I don't know, 25 million, something like that. And you would do so at a relatively early stage for sort of a purpose of like getting towards a construction decision or something like that. If you do that, then you might have a period of, say, a year or two thereafter where you're first in line to put more money to work for the purposes of building an asset or for a follow-on transaction of some description. If you do that, you actually work hand in hand with the company for a period of 1 to 2 years, maybe you're involved, to assist them with, some technical aspects through, steering committees and that kind of stuff. And if that's the case, by the time you put more money to work, it's a known quantity. You know exactly what you're dealing with. You understand the company much better, and you understand how it works. You also have an opportunity to sort of fill out the management team of the company, help them make tweaks as is necessary in that sort of period. And so we found that as a fairly clever way to ensure that, when you really put the meat of the money to work, you somehow have de-risked the people aspect of that deal.
Yeah, I think we do kind of. Oh, sorry.
Go ahead,
Sure,
David.
go on. Okay, sorry. I think I'd agree with much of what Philip's saying there. That it comes down to meeting management teams that you trust to do the right thing when things maybe don't go according to plan. I think people talk about trust in many ways, but I think it's mining most projects. You have a plan. Nothing ever goes quite according to that. And whilst you're an investor in the company, you're not necessarily and you are an owner, but you're not the manager of the company. And you need to have people there who you believe will do the right thing without having to come back to you and consult and so on. Obviously, depending on what the situation is, they may do that anyway. So I think that trust comes from culture and governance, the right board, and having management teams and boards that recognize that you need different skill sets for different phases. So the people you need on the board for when you're building the company, they're not necessarily going to be exactly the right fit for a company that's in production and when you're looking to exit. And so I think that's what we're looking for as a group, is management teams who we can rely on, we can trust to do the right thing, who have embedded and lived the kind of culture that we want to see, but also recognize that skill sets need to evolve and change as the company status evolves and change. And I think, as Phil said, putting money in earlier and helping a company go in the direction you want to go before you put in, bigger dollars is, has been something we've tried to do on many occasions in the past.
Yeah, I'd add to that by saying, on the first hand, I think everybody does their upfront diligence in varying ways to gain the measure of what a management team and a board looks like and how the governance is. I find the governance part on the board perhaps at times quite difficult from the outside looking into, form judgments on until you're actually in there, other than through reputations. And I find very often that's proven a bit frustrating over time. The management teams themselves, I mean, we've not participated in certain transactions based on track records and perceptions of the execution capabilities of management teams, whereas others have gone down those roads. I do think, having been in the industry for nearly 30 years now, this is not a very big sector. And so, just those networks alone, headhunting firms usually call guys like us anyway to try and form views on good candidates for specific roles. Even in putting my own team together over the last 4 years, like our last hire, we had over 400 candidates for that role. When I was looking for a top-notch geologist, we had a couple of hundred for that role, which was quite specifically constrained. And in our model, we did an investment in Mongolia a number of years ago, which has come online this year. A lot of that judgment was around the background work we did on the entrepreneur who had a good track record in that region and on delivering. We did work with former Canadian ambassadors in the region, guys who were former chief operating officers in Oil Tolgoi, had lived and worked in that region, understood the sort of lens that we would look at it with. And we did that all pretty much in-house. If there are regions that we are less familiar with, where we think there's an interesting opportunity, we will work with external groups who maybe can bring something. And we make sure we'd rather invest their time and effort up front very deliberately, because it's table stakes and it's not expensive in the grander scheme of things. Because at the end of the day, you back the wrong team and it can be excruciatingly expensive. But I think generally it's a good environment, and I think a lot of people at various stages of their careers gravitate towards private equity type of exposure, and I haven't found it difficult to assess good talent or certainly attract talent when we need to. But I do find the board side on occasion has been a bit challenging.
Yeah. Right. Thanks for that. So let's move over from the people element to ESG, which of course is the most crucial element moving forward as part of not just operating or social license to operate, but investing as well, of course. I mean, are PE developing robust internal ESG filters rather than relying on industry standards for reporting? I mean, Shaun, you mentioned in-house work versus external work when you need it, but I mean, based on the trend and the inevitability of how important this is, are you seeing that there are specific internal robustness being built around assessing the targets or the investment possibilities?
I know everybody's talking about ESG, and it's front and center, as Philip said. In some ways, I do feel that under a different brand with sustainability, and that mining companies have been focusing on this for a long time, license to operate issues, making sure that your people, your communities are taken care of. And there is plenty of skill set and capability out there to look at tailings dams and to be able to look at health and safety track records and things of that nature. I think the areas that from the outside looking in on occasion, it's a little harder to get a true feeling of is just how well they are regarded from a community engagement perspective and license to operate. We did an investment just over a year ago in Colombia, for example, and we put a lot of effort to understand the dynamics in that area. And at that point, Newmont was engaged in that. And so we spent time with them in order to gain a far more granular understanding. We invest alongside our partners as well in some of their community programs once we make investments, just to be part of that ecosystem and support that. But we do find, I mean, if you're going to be there for many, many years, you have to be a good good custodian of those relationships. And so it's not always easy to get a good handle on that. There's a lot that can make headlines, but that's tough. I'm always struck by just how subjective this is still for different groups. When we looked in, without getting too specific, it was a region in South America. Most of our deal flow is proactive, similar to the rest of the guys on this call. And we were scanning the universe of the possible, and we looked at it first from an ESG perspective, as we did in South Africa when we made the RB Plat deal. We narrowed that down to 1 or 2 targets, and there was one in this particular region that we liked the asset, but once we looked at the background work on the management team and the owners, the controlling shareholders, we backed away. And it was interesting to see, fairly recently, a listed competitor who's gone and done a transaction with them, and it feels as if the market has just sort of shrugged it off. In our view, it was sort of radioactive, whereas through the lens of a listed peer, it was, oh well, that's fine. So I do think it's clear that I'd rather be on the side of the angels on these things, but there's clearly subjectivity on these things in the market, and I assume that's just going to continue to evolve.
Yeah, I agree with Shaun there. I mean, I think we spend a lot of time looking at these issues, as everybody does now, but I don't think there's a common standard or level achievement that you can say that's guaranteed to be perfectly good, because I think each deal and each project is kind of unique and has its own unique challenges. And so I think there is a risk if you have a kind of a standard, common standards, that it becomes a bit of a tick box exercise, and someone says, well, I've done X, Y, and Z, and therefore I'm compliant with whatever the standard is. I think you need to look at it. Yes, it's important that if there are international standards, that your management team and company is working towards those, but I think it goes beyond that, and I think it goes back to that point about trust and culture and an organization that is committed to doing the right thing to its host community. I think from RCF's perspective, we spend a lot of time on this internally. We have a responsible investment officer whose job is to help us do that analysis and work through the assessment and make sure that we are doing the right thing and putting the right covenants in place and protection for ourselves and our investors. But I think there's still a lot of subjectivity here, and different groups will form a different view on whether you can, if you look at something and there is an issue, whether you can kind of retrospectively address that, or whether the damage has been done. And even if you go in with good intentions, you'll always have that legacy. And I think that varies asset to asset and company to company.
Yeah, so I mean, from an Orion perspective, as I mentioned before, ESG has always been really quite important to us, but now it very much is top of the list. So we've raised our third flagship private equity fund, and for that fund and for funds going forward, we hired Robin Weissman, actually, who used to work at the IFC and actually was partly responsible for writing the performance standards, which I think really form the backbone of project finance in countries which which aren't designated countries that have kind of like the right framework in place in legislation. And it's our filter really is that we do require that our portfolio companies close any gaps that exist between those performance standards and where they are. That's really the most crucial thing, and I think it's exceptionally important for us culturally to make sure that things are done correctly. And we want to associate ourselves with companies that share that viewpoint. And so that's what we do. But having Robin involved in our organization has really helped everybody understand not what the rules are, but actually understand what you need to do to get this right. Because sometimes these standards just don't go far enough. Sometimes people can interpret them in different ways, but really understanding how you go about things, get your social license, and so on and so forth, and do things right it goes way beyond any standards. So yeah, I think that in terms of filters, as we put it, we have a filter in place. Yeah.
I think just to tag on to Philip's point, I think in most cases you can adequately check, whether people have done the tick box type things as you would expect, but it's harder to ascertain sort of the cultural embracing of those standards. And that ultimately, I think that at the highest level within leadership is a key determinant of how the organization is actually going to permeate the rest of the organization with those as priorities. I think there's opportunity for that to continue to evolve. I mean, we've seen, unfortunately, what happened with Rio and elsewhere, and it's not unique. I think all organizations that can have the right standards and the right approaches, if it's not forefront of the mind, mishaps unfortunately can happen. I do also think that for us, it feels a little bit like there's a need for convergence where financial institutions are focused seemingly in some ways on longer term important strategic issues on the ESG front, from diversity to climate change targets. There's a whole series of these, but at the same time for us, we've got to make sure that those things are there and that there's actually some credibility associated. But importantly, the stuff on the ground in the short to medium term has to be right. Are there any relocation issues that need to be taken into account? Do they actually have the right culture on the ground to be able to work well with their communities and be proper custodians of the environment? So I think there is those different horizons and those different lenses that actually do need to come together more. It feels like they're not there yet, I don't think.
Yeah, so a follow-up question to that, and as David pointed out, every deal is so unique from an ESG perspective. I mean, the jurisdictions, the political risk, all the things put together. And Shaun, you just mentioned the stuff on the ground, which is really the near-term stuff that you can, to the best of your ability, try and quantify or assess. And I'm just curious, reflecting over the last few years, are there any ESG elements that are proving harder to track than others? Are there trends that keep coming up that you guys perhaps struggle, maybe that's not the right word, but find it more challenging to determine than other elements?
I think the kind of community engagement probably is the hardest bit, because as a company, you're investing in a company and they may have a good community engagement program, but it's understanding how the community feels they've been engaged with, if you see what I mean, which is the hardest point to measure. I think things on the environmental side are probably easier. You can do your water sampling, you've done X number of samples, you've got X amount of suspended solids. You can address that and put programs in place to manage those kind of things. But I think it's from our perspective, it's understanding what the local community feels and being confident that the engagement that's going on is having the right reaction and results, and that they feel they're benefiting from the local, from the investment that we're making in the mine. I think that's, from our perspective, is probably the hardest one to quantify. I'm not sure that necessarily means that there's been lots of issues, over the last few years of deals we've done. But I think if you're wanting to try and thinking in terms of data and numerical points, that's probably one of the hardest ones to put in that kind of way.
I completely agree, and I think that even though it's one of the hardest ones to measure or to understand, it perhaps is the most important of them all in ESG. Because when the tide turns, it's very, very, very hard to turn it back. And so, yeah, we spend a lot of time, and we're going to get it right every single time. But yeah, social attitudes. How can you really get your finger on the pulse as to what communities are thinking? It's not through the number of community outreach programs that a company has in place and the number of meetings that have taken place with the community. That's not going to tell you anything. You kind of have to just get out there and really understand the concerns of the community, and whether or not they're being adequately addressed. Very hard indeed.
Yeah, I'd agree with that. But it's been quite interesting for me to see during this really unprecedented time we're living through with COVID now, to see how some of the management teams in our portfolio have responded specifically to the needs of their communities. And I look at the RB Plat team in South Africa when this hit. They've got a lot of doorstep communities with kids that have no connectivity, whose education has been substantially impacted. And frankly, just as good custodians of those relationships, we've put some money alongside them into getting simple, tablets and connectivity so these kids can continue their education in some way, because the alternative is that, for some unknown period of time, essentially they cannot do that. And just seeing how spontaneously they've gone about that, how they've worked on community education and other areas, I think has been refreshing. It's been great to see. Similarly, we've seen with Zijin in Colombia, just how careful they've been to be at a time when they've been finishing construction, going into ramp up, how they've really stayed incredibly close to their community to understand the natural concerns that people would have about having strangers come into their communities, and the perceived risk that has around infection and things like that, where they've had to go through this period with less than half their construction workforce. They've put strict protocols in place. They've actually put programs in place to support their communities from a financial perspective during these difficult times. So I think it's that it's the walking the talk that's really been in evidence with a lot of businesses, which has been wonderful to see. I think the only thing I'd perhaps add to, you asked about metrics, and I know out of necessity we focus a lot under this banner of the environmental health safety components of this, community relations, but the governance part at times it reveals itself with time, and particularly when teams are either under stress or otherwise, how boards behave. We've seen times where you've got very strong founders and the boards themselves perhaps don't have the depth to be able to provide the necessary independence and governance around that. And I think over time, that's an area that unfortunately, you judge with hindsight as much as you do with any sort of foresight. I think particularly on these single asset investment opportunities, at times that can be a weakness that really does need addressing.
And then just a final point on ESG. Shaun, you just mentioned the walk and the talk, which leads nicely into this question around, some miners are obviously doing a better job than others. And although this is not a session to name and shame miners that are good or bad at ESG, I'm curious if they're considering the crucial, how important this is moving forward. I mean, it's the most important thing for Orion, I'm sure for you guys as well. Are you seeing any trends of certain companies or types of companies? For example, are mid-caps better than this, the majors? Are juniors worse at this because they're underfunded? Like, are you seeing any trends, or is it a complete unique situation per company in terms of how well they deliver ESG efficiently?
It's a good question, actually. I think there are problems with this across the board. I mean, we saw what happened in Australia with Rio. We've had what's happened in Brazil to Vale, and I suppose to BHP as well. So this is not a junior problem exclusively. This is, I would say, fairly industry wide. I'm not so sure about there being a clear split at all. I mean, I do see junior mining companies have projects, and they sort of have to introduce the performance standards to them, because I complain, would you like to, do you intend to apply the IFC performance standards? And the response is, IF what? So, that kind of, you do see companies which just are not, they don't care, right? They're not doing things in the modern way. Other companies are the opposite. We invested in a company called Horizonte Minerals, which is a nickel developer in Brazil, and they intend to go into construction next year, and they're out with a sustainability report. I don't think I've seen that for a development company. So that's an example of where things, and the attitudes and the cultures of a company, even though they're a junior, are absolutely right. And that goes throughout everything they do, from their engagement with the community on the social side of things, through to the way that they're going to treat the environment and protect it when they build, all the way through to hiring close to 50% of their workforce in women. This kind of stuff. So they're really good examples. There are some bad examples too, but I'm not sure whether there's a sort of split that you could point to in the industry, or define a split.
And I think adding to Philip's point, I mean, clearly smaller organizations just have a bandwidth and a associated sort of cost overhead concern, but there's a lot of external groups that they can work with. I think, if you've got the right leadership and culture focusing on this, the rest falls into place. They will find the resources that they need out there in order to get this right. I do think the pendulum can swing too far the other way, where you have these large, slightly bureaucratic organizations that can run counter to having the right culture at times, and you feel placated by the fact that you've got all these policies and procedures and all this reporting in place, but that's only part of the equation. You really do have to get the leadership and culture right, and I think capital providers have an essential role to play. That if this isn't seen as a truly consistent gating item, you are going to see apathy, or at least very slow adoption of this going forward. I think it's trending clearly in the right direction, but it probably needs to be more urgent and a little bit more focal.
Yeah, I think I agree with the points made by everyone, and I think it's across. There's very good companies in every size, and there's poorer companies in every size position as well. I think certainly at the smaller end of the spectrum, companies that don't take it seriously, I don't think will be able to raise meaningful capital and advance their projects. So I think that's the ultimate carrot and stick for management teams to adapt the right policies, and more importantly the right culture. I think it comes, all these things come back to people at the top leading and instilling that through the organization. And having come from bigger organizations, I think that sometimes trying to retrofit that to a big organization is harder than it is instilling it from the beginning in a smaller organization.
Absolutely.
Yeah, we've got two more questions. We'll end with a fun one on gold bull market predictions. But I think we've spoken about the technical element of DD. We've spoken about the de-risking it, the people element, the ESG element. Let's talk a little bit about the mechanics in the COVID environment. I mean, how are you actually executing on due diligence in this environment?
Yeah, well, I must say I think I mentioned earlier, we found this to be literally our busiest year, and we've deployed more capital this year than any other. And a lot of that is, I guess, just being opportunity and needs driven. The devil's in the detail though, and by that I mean some of those deals that we've executed have been alongside operations we already know and understand well. Some of them have been areas where there's more than enough adequate data, and the actual check size and the risk profile is it works. The other was an asset with 25 years of history, a top tier asset with decades of life and a very good management team in place. And in a place like Australia, where I've been operating there on and off for decades now. So a lot of the guys I would have used in specializations to go to South America or otherwise, if they could hop on a plane, happened to just be a car ride away down the road, which is pretty convenient. It would have been difficult, for example, if it was, say, a greenfields opportunity with a series of risks we really had to assess, and we couldn't get people that we knew and trusted to sort of cover the ground for us adequately. I think those are things we just accept until things normalize somewhat, are just not, for us at least, attainable. But there's a lot going on, and it's been an interesting space, and I do think each situation you have to look at on its own merits.
Yeah, I think, to add to that, I think we've seen a lot of opportunities this year. I think the initial reaction with the kind of lockdowns early on, did certainly slow things down and make us think about how can we do DD. The advantage we have with a global footprint is we do have people in a lot of the key investment destinations. So we've been able to get teams, on the ground once things started opening up again in Australia, in North America, relatively easily. Maybe that's not quite the right word, but being able to do that. But there's certainly some places where we just can't get people, and there's probably not the level of local expertise and connections that we can rely on to be able to do that kind of semi-remotely, where those kind of opportunities will have to wait, unfortunately. But I think we have found a good range of opportunity and been able to do the DD that we need to do on transactions that we've seen so far this year. But obviously it will be easier, if people can travel around from A to B without the current restrictions.
Yeah, I think that basically Orion is in exactly the same boat as both of the chaps that have just explained their positions. We've been really busy as well. I have to say that most of those deals have come from assets which we're already familiar with, or been producing for years, or happen to be located in a place where there is an Orion office, or one can actually get to, or if we have trusted advisors in those locations. The thing I'd say about Corona actually is I think that just as a general point, things have just been a bit slower. You could add on, I reckon you could probably add on 20% or so to the time it's taken to actually get something done, just because productivity rates are lower. That's the sad thing, but yeah, it hasn't stopped business. So yeah, we're still doing deals.
Yeah, I think I totally agree with the point about things being slower. And I think the fact that there isn't a specific destination where it feels like we're going to have clarity on some level of normality, I think is probably weighed on people as well. But yeah, it's 6 months ago, I was really concerned that it would be highly restrictive on our ability to get things done and our management team's desire to move things through. But ultimately, necessity tends to drive transactions, and it's amazing what people can do when there's the desire within those organizations. You can't. There's no substitute for it.
All right. Gents, thank you so much. I'm going to close with a final question. I think Philip's already given us a little bit of a peek under the bonnet here in terms of what his strategy is, but I'm very curious, and I'm sure all our viewers will be very curious on your views on the gold bull market and the equity markets, and whether conditions are indeed favorable to start thinking about exiting some positions.
So from our perspective, we're still quite bullish on gold, actually, particularly in the short and medium term. I think that there's so many of the factors that drive the gold price are in play right now. It's a very positive environment. I think that the price will stay strong for a couple of years, actually. That doesn't mean to say we've stopped doing gold deals in terms of new investments. There's one rather large one which we're working on right now, which is a special situation, which we think we can unlock value from. But I would also say that we've been quite fortunate that over the past 4 years also we've done actually quite a lot of gold deals. The portfolio has been more weighted to gold, probably about 75% actually. And so we're looking at those investments, and we have been monetizing some of them, but we're looking at which how we might be able to do something else other than just sell down that could really maximize value from those investments. So there's lots of strategic thought that's going into how best to go about that and take advantage of what we think will be a strong gold price environment for some time.
Yeah. Look, we don't make investments. Sorry, go ahead, David.
No, go on.
Yeah, no, look, we don't make investments on the basis of assuming heroic gold prices. We always look at scenarios, but I mean, we are fundamentally constructive on the outlook for precious in general. Certainly that short to medium term that Philip mentioned. I was listening to a talk just the other day where they're pointing I think it's 30% or so decline in reserves of gold producers just over the last 5+ years. I think the average reserve life now for the gold producers in the sector is sort of 7 to 8 years at this point, and certainly McKinsey's speculation was just with the underinvestment in greenfields and elsewhere, this notion of peak gold perhaps kicking in as soon as 2023, and then you've got the backdrop of low rates and a lot of money printing going on with this crisis. So those all seem to bode quite well as we go forward. I do think for us, the sort of arbitrage for us looking at streams and royalties, for example, with polymetallics is about as attractive as it's ever been when you look at some of the, say, copper gold ratios and others. So there's an interesting arbitrage that's available, which I think will help continue to drive deal flow. And on the exit piece, I mean, for us, we're looking to add to our portfolio. A lot of this comes down to what you're trying to achieve and incentives. So, we're not focusing, for example, on selectively selling off individual assets. We're building out a portfolio, and that is a long-term lens, through the cycle that we're ultimately developing it. We had one, for example, small buyback on our Colombian portfolio, which is sort of more an exception than the rule, which Zijin just exercised. But that, for example, will come in at the end of the year. That's 80 million with a significant, I think it's like 40% plus IRR on our investor capital, which gives you a sense of, I think, just the general sense of optimism that groups are seeing out there for the gold market going forward. I think there's clearly a lot of bullishness on this market for some time to come.
Yeah, I mean, just to add, I think we're also fairly positive on gold in the medium term as well. But I think to answer the question, I think it certainly doesn't hurt that the public markets are more buoyant in precious metals now. And in terms of exits, if we have equity positions, then yes, absolutely, it definitely helps that. And I think there's been a few, I suppose, sector consolidation in the precious metals, and I think that's probably the key driver for a lot of the bigger positions and exits. But I think a strong price and bullish market certainly helps all of those. So.
All right, and so thank you so much for participating, Shaun, Philip, David. Thank you so much for your time. Adam, thank you so much to you and the one-to-one group for teeing it up. I'm sure a lot of people will find a lot of value. So that's all from me. Thank you very much.
Thanks very much.
Thanks a lot.
Have a good day.
Thanks all.